Hey everybody, it's Mike from Orderflows and welcome to today's video. It's coming up on the year end. Believe tomorrow is the last trading day of the year, December 30th. And, I was watching someone's video that they had posted on Orderflow and I got a little triggered again, trigger alert. And, the person, although their style of trading deals with stacked imbalances, okay, fair enough. There's many ways to use order flow. And, stacked imbalances is one of the ways. I use stacked imbalances, but order flow is so robust. There's so many different things that you could look at in the order flow. But what triggered me is they made a comment that order flow isn't useful in commodity markets. It's only really applicable to the stock indices, which is complete and utter nonsense. There's so many successful order flow traders that trade just commodities, right? They trade the grains, they trade obviously the metals and crude oil. They don't even touch the equity markets. And equity markets, they sound cool, sexy. I trade the S&Ps. It sounds much more professional than saying I'm a wheat trader, I'm a corn trader, or I'm a copper trader. People say, hey, well, you trade corn, you trade wheat. But you know what? The same principles that apply in analyzing the order flow in the equity markets apply to the commodity markets. Honestly, up until the stock indices, really started taking off in the, I think they're introduced in the 80s, but, the E-minis didn't come around to the late 90s. More millionaires were made in the soybean pit than any other trading pit out there. And, I just want to talk about, looking at commodities, relative to some of the stock indices. Now, this is a E-mini. This is just a 1-minute chart. This is from today, December 29th. And, this green line is up here at the high. And, we started coming off from that high. Okay. And when you're looking at the order flow, this is why I like using order flows, because, it just makes understanding what's happening at a high of the day easier to trade. Okay. Because, again, not every single high is going to be as easy as this one. But we're coming up into the high. You get some nice positive delta readings, okay? Point of controls are going up. Delta is 144, 316, 646. Then you start to go sideways. As you're going sideways, you got negative delta, but it's kind of small. Negative delta, minus 16, minus 38, minus 50, minus 43, minus 223, minus 600. And you got a nice big stack selling and balance sticking in right there, right off the high of the day. And, the market proceeds to sell off from about the 68 area down into the 62s, within about 10 minutes, right? That was a nice, easy trade to take if you're looking at the E-minis today. Eventually we did sort of come back and take out those new highs. If you're watching the imbalances, like the stacked imbalances, you had one here, you had one coming in here, right as this move is starting to kick off. Later in the session going in near the close, again, very nice delta reading. If you're watching it going into the close today, you're sort of going sideways, then you see the deltas really start to pick up here. Minus 116, minus 271, minus 900, stack selling imbalance, and the market again sells off from around the 74-ish area, down into this, literally down to 70. Then that's when the cash closed. So, when I hear, you can only use order flow on the stock markets, the stock indices, the E-minis, etc., and not the commodities. That really bothers me, because when I first started using order flow, I traded commodities, right? I traded wheat, soybeans, palm oil, right? Palm oil is traded in Malaysia. It's because I was working in Asia, right? That's how I know about those markets and how I know that order flow works in it. So let's take a look at soybeans here real quick. ZS is the symbol for the Chicago Board of Trade soybeans. And we'll just pull up the chart here. Come on, Ninja Trader. There we go. We'll just go back, to today, right? This is 1-minute chart. Same chart that I'm looking at on the E-minis, okay? So market opens up at 8:30. It trades overnight, but, the main session starts at 8:30. And we're going up. What do we get as we're going up? Nice stack buying imbalance going up. Point of control sort of moving higher. You get up here to this highish level right up here, and things start changing. You'll notice as we're coming up into this high, it's getting a little bit weak, right? You got negative delta just off the high, and then big strong burst of buying, big strong positive delta, 559, and then negative, small positive, strong negative. We're still at our high, and after that big burst of buying, basically no continuation. We just see negative delta, 77, and then small positive, 27, big negative, minus 187. Hit the high again, very small delta of 4. Take into a new high, and it's a red candle with positive delta. People say, well, okay, you got positive delta at the high, but what you have is a delta and bar divergence. So you're at the high of the day, positive delta. Okay, that should be encouraging, but why is the market closing down? Because I see supply coming in here. You see this volume, the 177, which tells me that there's people willing to sell it up here at this high. And then you go small delta 10, and then big negative delta minus 110, minus 61, minus 57. So we're up here at the high, and majority of the delta after that big burst is negative. Okay, what do you make of that? You're at the high of the day. You're seeing selling coming in. Not only are you seeing the aggressive selling showing up in the negative deltas, but you're seeing supply coming in the form of strong passive, right? Liquidity in the market. Liquidity is being added into the market. People are working limit orders up here at 1524. They're absorbing whatever buying is still, buyers are still coming in to trade, and market is reacting to that. Okay, come back up here, sort of test that high, back up here to 24, right? We had that 177 here. Remember, now that was at 1524. Market sells off down to 19 and a quarter, rallies back up where? To where that you had that supply. You can see the point of control right on the edge of the bar. You can see the volume, 142. What happens? Market reacts to that. Goes sideways, eventually starts selling off. And even on this move down, you're seeing, again, more supply coming into the market here. And you're just seeing, nice selling on this move down. Right now, I get why the person was saying, commodities don't really follow order flow that well. Is because they base, their whole strategy, the software that they sell is a system based on looking for stacked imbalances, right? Stack buying imbalance, stack selling imbalances, which is fine. But in commodities, in certain commodities, like soybeans is a little bit more volatile, but it does have nice volume. But if you're looking at, another market like wheat, okay, this was soybeans. But if you're looking at another commodity such as wheat, yeah, you're just not going to get that many imbalances, stacked imbalances in the wheat market, just because you're going to see imbalances, but they're going to be sort of spread out. They're not going to be stacked neatly on each other the way that you'd see them in other markets. And it's the wrong symbol. Let me just pull it up here. This is pulling up the stock, so I don't have stock quotes. But basically, you're not going to get it because the volume is just not there to give you those stacked imbalances. So this is wheat today, right? You don't see many stacked imbalances. There's one here, one there, one here, one here, one here, okay? So, and that's about it, right? You get a lot of times in commodity markets where it's just moving like this. And if you're just looking at stacked imbalances, that limits you on what you could look at. You'd have to change basically the type of chart you're looking at. You probably couldn't use a minute-based chart. You'd probably want to use a range-based chart, okay, just to give you a little bit more movement. So again, to say commodities, you can't use order flow in commodities is just nonsense, right? There's so many traders out there using order flow on commodities. That's all they look at. This is gold. Let's go to a 1-minute chart here. Gold's a great market. I'll talk about copper in a second. Copper, is one of these underrated markets, but same sort of things. Look at this, right? Come up. This is today. Come up to the high. You got this nice reversal at the high. You hit the high. What do you got? Negative delta. Okay, so you got a divergence. Not only that, you got that imbalance, that buying imbalance. So I know there's supply coming in here to help push this market back down. I sort of see a sweep taking place with all this lack of counter trade here. You can see the 5, the 0, 0s, and the 9. So it's telling me someone just came in and whacked it down through about, from basically 2680 down to 2650, so about 3 ticks. You got a nice stack selling imbalance there, and the market just drops off. Okay, it's the same sort of analysis that I'm doing whether it's E-minis or soybeans or gold, right? Let's take a look at some of these other highs, right? Going into the highs, nice aggressive buying, stack buying imbalances there. That's what you like to see. You come up here, these guys are kind of trapped. We don't go build off of it, but you'd be looking at the same things, right? It's not like you're looking at different things, but you do have to realize, depending on the market that you're trading, if you're just focused on one piece of the order flow, yeah, it might not be effective in certain markets. For example, let's take a look at, take a look at, gosh, HE. I think that's hogs. Nothing exciting about trading the hog market, but you're still going to be essentially looking for the same thing. So here's a market, right? This is a 1-minute chart, very thin volumes. So yeah, trading order flow is probably not going to be very effective if you're looking at stacked imbalances. But if you're looking at other things like the delta, honestly, on a 1-minute chart, there's not much to go off of. You might want to bump it up to a 5-minute chart or a range-based chart. But there's going to be times in every market where there is decent volume being traded. And, really what you want to be looking at is, how's the market reacting, around the lows? Is there signs of aggressive buying? And this is why I like commodities more than equities, is because, really the traders that are trading, some of these markets, they're there for a reason, right? They have to trade it, right? They either need to take delivery or they have the supply that they've got to move. So, personally, I find it holds order flow, much more truer than, say, some of these markets just have, people are parking their money there, then they got to take it out to put it into another investment. That's what S&Ps are for, right? People get out of one market, they need to park the money, so they park it in S&Ps. They don't park it in markets like, hogs or copper. Let's take a look at copper. I like copper, HG. But, if you really had to trade this market with the order flow, you can, that market meaning hogs. There's certain things in hogs that I like to look for. I don't trade hogs, but sometimes people ask me about it, and I take a look and I say, yeah, you should key in is this or that. So this is copper. Okay, let's just go back today and look for some interesting things here. So, there's always interesting things in the order flow. So this line is the open price, 383.50. Okay, and I think today was kind of a quiet day. But, what you'd be looking for is, signs in the delta that aggressive trading is picking up or cooling off. Most of the time you're seeing some small deltas, small volumes. Overall here, it's kind of a quiet day. But there's going to be times where things really start to pick up, okay? And you can sort of see it in here. You're starting to see some stronger deltas, some heavier volumes come in. Just sort of looking at this as it's going sideways, you're seeing some decent negative deltas, -13, -19. Okay, then it just goes back to -6, which is nothing. 14, okay, -9, then 0, 5, 3, then -27, -66. So there's selling is picking up here, okay? Then it doesn't make much of a move. It just sort of goes sideways. Eventually it sort of works its way back up. But as it's working its way back up, you see the deltas now starting to pick up, 53, 41, 98. The aggressive buying is coming in. Looking at the delta divided by volume, right? Some strong numbers, 41, 46. So you know that the aggressive trading is really starting to pick up here, right? Sort of gave you this false sense of security that maybe this market's going to sell off. Okay, that's fine. You get short maybe in here somewhere, but it just sort of hangs around here, doesn't go anywhere, right? But as a trader, you have to be able to recognize when the market's not really moving. You're starting to see some signs here with the delta divided by volume, picking up some nice strong ratio numbers. That's why it's colored blue. But again, even if you're not convinced by that, some people go, hey, how the hell am I supposed to trade this? It trades basically the bid and the offer, and one tick above, one tick below. But by the time it gets over here and you see the volumes start to pick up, this bar's got 600 contracts traded, and then followed by 99, followed by 200. Maybe now you're a little bit more convinced, as opposed to here, where it's just trading 20 contracts, that this market can go higher and starts working its way back up, from the 382.70, all the way up to 383.30. Okay, so again, don't fall into this thing that order flow is only effective on stock indices. Bonds, ultra bonds, great contracts to trade, 10 years. Technically not commodities, obviously they're not stocks, but those are markets that trade decent size during the trading day, where there's a lot of volume, right? This is a 1 minute chart, but honestly I like to look at 5 range charts or 4 range charts in the interest rates. Makes it just a little bit easier for me to understand when it's sort of taking into account what's happening in terms of price movement. And again, if you're looking at stacked imbalances, you're not going to get very many, right? There's imbalances taking place, but they're kind of spread out. Whereas if you're looking at an E-mini chart, go back to the E-minis real quick, you're going to get a lot more imbalances just based off the nature of the market. So again, order flow is very robust. There's so many things you could look at. You could look at obviously imbalances, stacked imbalances. You could look at multiple imbalances. You could look at point of controls. Where the point of controls lie in the bar. You look at delta. How's delta? It's just easier sometimes in markets that trade a lot of volume. You get more of a grip on it than markets that don't trade a lot of volume. But that it's just nonsense to say order flow isn't applicable to commodity markets. It's just nonsense. So anyway, guys, I hope you appreciate this video. It's kind of a gripe of mine about when people say order flow doesn't apply to commodity markets, when actually I find commodity markets much easier to trade than the stock markets. So, but that's just me. All right, everyone, we've all got our opinions. We're all entitled to our opinions. So throw stones at me, whatever. Just be sure to like and subscribe to the channel so we can continue making these videos for you. So anyway, guys, have a great day, and I'll catch you guys on the next video. Bye-bye.